gonna record this lecture. I'm gonna once again emphasize we don't have class next week, and it's very likely that we don't have class the week after. And then the following week is gonna be the spring break. So we are gonna have a big gap. Once again, in this big gap, if you are up to date, continue to work as is. If you are not up to date, try to catch up with the work that you haven't submitted, okay? So the last thing that I want to say, so I'm gonna accept the reflection paper for those who did not send the first reflection paper, but I'm gonna I'm gonna penalize those who were late. And remember, this assignment is a writing assignment. Many people, I have seen many, not many, thank God I haven't seen many cases of plagiarism. So I know it's very difficult. Writing is not easy. But those who are having problems with their writing, please do it. And if you have issues of plagiarism, you have to resolve it, okay? So plagiarism, we are using Turnitin. So that means that you can submit your paper and you can see at the originality report. That is very important. The originality report gives you how much you are, I mean, I have seen papers with 40, 50, not too many, but several that should not be the case, okay? So, and in some cases, some plagiarism might be not tolerable, but that can be a false positive from the website. So last time I small tools. So this website is called smallesotools.com. So I always, so when a person sends me a paper, and like, for example, some people have sent me papers via email, I go to this place, I copy and paste part of the, so part of the paper, because this only can search up to 1,000 words. So if you want to know how well before submission, so go to this smallseotools.com and find this plagiarism tool. So it's very good. Most of the times it's very accurate. I have seen many people doing, like they send me the paper, I copy and paste it, and I realize that your paper is fine. So my point is, before submission, you can check your paper and see how much plagiarism you can find. And if there is any, redo the paper. And if you check your paper here, and then when you submit it via Turnitin, your paper happens to be wrong or has a lot of plagiarism, issues of originality. So you have a backup. You can say, look, professor, I checked my paper and my paper is fine. So at some point, you probably might be able to take a shot, like a screenshot here, and just keep it for your records. Because if Turnitin gives you some false positives, so at least you have a proof that your paper is going to be fine. Also, what I want to say is 1,200 words are 1,200 words. So I have seen people with very short essays. That is not right. So you have to submit at least 1,200 words, okay? I know it's a lot, but writing is not easy, and writing has to be part of your lives. So, so that's the reason I am emphasizing this aspect of the course. So once again, before submission, go to smallseotools.com and find the plagiarism section of this, and then just copy and paste up to 1,000 words and click here where it says check plagiarism. So there are some other buttons that can distract you, but make sure that you click here, and then at the end, it's gonna give you a report somewhere in here. So in this section, it tells you exactly what is wrong with your paper, okay? Hopefully nothing is gonna be wrong with your paper, so please, so make sure that you do that before submitting your work, okay?
I have a question, Professor.
Yes, sure.
Yes, for my first paper, I had so much problem like reducing the amount of words that I had. So I would like to know, if I go to like 1300, let's say, is that a problem?
Oh, no, no, not at all. Not at all. That shows me that you are doing your work very well. I mean, it says at least is the minimum number of words. So you can do more. It's not at most. So it's not less than. It says at least 1,200 words. That means you can write more. I know, I mean, I'm very happy to see many good essays, and I see that people are working and they are writing very good papers. So I really want to see that. And if you are spending more time, meaning you need more space, I'm happy to see that.
Appreciate it. Thank you.
Sure. No, of course, of course. Thank you for asking. That's a very good question. So, any other question?
Professor, if we are we able to resubmit our first reflection paper if we didn't get a good grade?
Please do, please do. So that will be good. So that's a very good question. You got a very bad grade or a bad grade. So try to do it again, do it very well. And remember, it has to be free of plagiarism. So my point is the following. It's very hard sometimes because we are writing concepts, and concepts sometimes we are using the same words. So in this case, what happened is that we are paraphrasing. So paraphrasing means that you are almost using the same words or probably the same structure of the sentence, but you are using different words. So Turnitin says that is not right and says that is plagiarism. So you have to find your own words. And sometimes you write the sentence and then you realize that there is some plagiarism, just redo the phrase, express it in another way. So writing is not easy and requires a lot of exercises. So yes, please, if you didn't do your first, or if you got a very bad grade, please resubmit your paper, and has to be complete, at least 1,200 words. So you have plenty of time, guys, and I hope the second one is good, and that's probably what I want to say. Okay. So so we have well, basically we have been reviewing the news. So my advice. So another question?
Yeah.
Yes, please. How?
Yeah.
Yes, please.
You see how like out of the whole percentage for the reflection paper, it's out of 6, right? Like, for example, obviously you get less than a 6, but it's not close. It's not close to a 6. What do you recommend doing? Like, if you want to just get a 6, like, do you do like at least another paragraph or what, just to boost up the grade a little?
Say that again. So what is your specific question?
So so I got out of the 6, right? I think it was like a 4 or like a 5 something. But let's example, like somebody wants to just complete it to get exactly a 6. What would you recommend doing?
Oh, well, I mean, in this case, you are fine. I mean, one point is nothing. So 1 point is nothing. So probably at the end, if you need that point, we talk again and we see how we can compensate. Probably your problem was either you wrote very little or less than expected. There is some degree of plagiarism that made me believe that was, like sometimes you see isolated words. I am not worried about this. But when I see a pattern of many words and phrases that come together, that worries me. So if that is your case, my recommendation is do better in the second and do better in the third. So if you need that point, talk to me and say, Professor, I did better. I whatever was my problem, I try to fix it, and we will talk. Okay?
Thank you.
Sure. So my point, once again, these are assignments that I want you to do, and I want you to succeed in those assignments. So it's not about penalizing people, it's about learning to do things, okay? So any other question? Okay, so if you give me one more second, I need to find my cable. So I'll be back in 2 seconds. Okay, I'm back. So if you don't have more questions, we're going to start with the class. And so once again, if you have more questions, send your questions via email. If you really need help with your assignments, as I mentioned before, I send that email. You can schedule a Zoom meeting either with me or with the TA, with Soleimani, and try to get the answers that you need, okay? So we are open to that, and we are hoping that you guys can use that resource. It's very difficult when you, so now that we are not in person, so we are gonna do our best to get, to make ourselves available for this, okay? So, so once again, let me disappear for a few minutes. So that was a good day for the stock market yesterday and today. Almost 500 points today. Yesterday, more than 2,000. So once again, this is a very interesting time for everybody because we are struggling with a big, major setback in the economy. So governments, as far as I can understand, they try to do the best they can, and I do believe that what has been done probably is not perfect, but given the circumstances, I guess I think is a good response. So both addressing the health issue and addressing the economy has to be done. So just imagine that in 2-3 months, if the country opens again, how many companies are going to be in good shape to go back to work? So it's going to be a big problem to make it work. So it's good that the government is taking some steps to prevent further damage, and that's what happens when governments are working. So at some point, I'm not very happy with this because once again, $2 trillion for government spending is going to be money that at some point has to be paid. And people who are younger, they are going to be carrying with this burden for many, or this debt is going to be carried for many generations. So that happens when governments spend monies in the economy. But I mean, in some cases, it's necessary. I don't see any other way. Is in 2008 we had a major crisis too, and uh, and the government at that time, they implemented a very strong rescue package for many companies. So many people said probably that's not the best thing to do, but in some cases, that's the role of government. Governments should help companies, should help workers, should help everybody when this time so happens. So anyways, I'm gonna shut up with these comments because I'm going in circles. So so we are gonna start with our class tonight. So this is a very nice chapter. I really like it. It's about international trade and capital flows. So as we remember, so we have these equations that we already reviewed in previous classes. So let me make this smaller. So we have our aggregate demand, our GDP, that depends on consumption, investment, government spending, export minus imports. Today, we are going to talk a little bit about this aspect. This is very, very important because this is the foreign sector. So if we put these two elements together, so we have a domestic economy, a domestic economy that is made out of private citizens and government. So this is the private sector, this is the public sector, and this is the foreign sector. So we have an economy now that includes the private, public, and foreign sectors, okay? So we are gonna see how these things are linked together, and we are gonna try to make sense of some of the issues that we face every day. Like, for example, we talk a lot about trade balance, right? Trade balance. And we said that trade balance is exports minus imports, right? So when exports are higher than imports, we have a surplus. And when imports are higher than exports, we have a deficit. And we mentioned many times, deficits for the US is very high. It's actually the highest in the world. So it seems that, well, the question is that deficit good? Is that deficit bad? Well, so far, we hear the news, and we probably might hear things in favor, things against. But let's see what the theory says, okay? So this chapter is gonna be related to international trade and capital flows. So we are gonna be talking about very interesting issues. So, so first of all, so we have, well, these topics. So we have how to measure the trade balance, look at the trade balance in historical and international context. So I guess this is a very nice chapter. So the point is, we are living in a world where we have our currencies. So as we can see here, we have almost currencies from all over the world. So we are part of the global financial system, which includes many different currencies. So far, we have some currencies that are considered hard currencies. So we have the US dollar. So we have the British pound. So we have the euro. We have the Japanese yen. And we have the Swiss franc. I think the Swiss franc is still. So all these currencies are called hard currencies. Why are they hard currencies? Well, because they, just imagine that you want to do a transaction. So you are a citizen of Mexico and you want to do a transaction with a citizen of Brazil. So you buy some machinery in Mexico, you place an order in Brazil, So the Brazilians are expecting money, and you are expecting that your money is going to cover for that particular machine. So what is going to happen? Are you going to use the currency of Brazil? Well, I don't know. Are you going to use the currency of Mexico? Well, probably not. Neither one might be a strong currency because the real and the Mexican peso, they devaluate very often. And that is not a good sign. So just imagine that your machine costs 100 reals, and then when you are gonna bring the machine back home, now it's gonna be 200, 300 reals. So that is not good. So it's the same thing in Brazil. They are expecting to get 100 Mexican pesos. But because the currency might have lost value because of many events, so rather than getting the 100 Mexican pesos, they are going to receive less. So that is not good for business. So in many cases, they use what is called these hard currencies. They use dollars, British pounds, euros, Japanese yens, or Swiss francs. So these currencies are very strong because there is a strong economy behind those. So we know that the US economy is the largest economy in the world. So also big contribution of the UK. The Eurozone also very strong. Japan is the third largest economy in the world. So that is not a surprise that these currencies are trustworthy currencies. Currencies that if you do business taking them as an anchor, you know that your money is not going to lose value. Okay, so that's very important. So far, we're going to go back to our initial equation. So we have the trade balance. So the balance of trade, or what we call the trade balance, is the gap, if any, between the nation exports and the nation's imports. So it's not a surprise either that in economies like the United States with high income, so goods are less than half of the total production, and services are more than half. So we look at this before, so we know that services account for almost 65% of the total production in America. And so we can have manufacturers and agriculture, but services are very important. So we have financial services, we have legal services, we have education, healthcare. All those are services that are produced in America. So, most of the economies basically are going to be based on service product, on the production of services. So, so when we talk about exports, so we are exports and imports, we are thinking not only in merchandises that we buy, but also in services that we are providing. So the fact that Citibank and Chase are in China, in Mexico, so that represents earning for Americans. But also remember that there are many foreign companies in the United States. So all these are going to be recorded in some extent. So this export minus import doesn't capture all the information. So basically, export minus imports is only a part of well, is made out of merchandises and other items that we need to include to account for the value of the financial transactions between countries. So we have this example. So also is very good to mention. So we remember that this is exports minus imports. So that is very important because we are hoping that, or I probably said once that having a balance trade might be good, but some countries have a deficit and some others have a surplus. So which one is good, which one is bad? Well, that's the reason we are here. So neither. So we can have a balance, trade balance, but we can be in trouble. So we can carry big deficit like the United States, but they're still doing very well. So some countries can have surpluses, but they can be in trouble. It doesn't necessarily that I mean, that is not a norm. We need to know more about how these things happen and how these balances are occurring. So and to see the impact in the finances of the economy. But what I can tell you is that sometimes these unbalanced either deficits or surpluses can lead to economies. So can lead to so some economies can be put into financial crisis, and they can fall into deep depressions. So we have had many cases where economies, they have a very strong trade balance, trade unbalance, either, well, basically deficits, and they fall into financial crisis, and that becomes recession. So we have many cases like Mexico in the 90s. I remember there was a very big and deep and long depression and long recession that became a depression. But not only Mexico, we have Thailand, South Korea, Malaysia, Indonesia, many countries that have had these trade imbalances. So so that is not good, because once again, so these things can lead countries to experience financial crisis and recessions and deep recessions. So that's the reason we have to keep an eye on these items. So we need to know how this works. Okay. So so we have made plenty of experience with countries that are are suffering from these issues. So let me so I get rid of this because it's so once again, we're going to take a look at the balance of the trade balance. But trade balance is one portion of what is called the current account balance. So the current account balance includes the trade balance. And trade balance, for example, has this merchandise trade balance, the balance of trade looking only at goods. Also, we have an item for services, and we have some other items. So this current account balance is a broad measure of the balance of trade that include trades in goods and services, as well as international flow of incomes and foreign aid. So it's not only the merchandises, but also capital flows coming in and out. So at some point, this merchandise balance and trade balance is gonna need of international capital flows coming in and out. And that is all recorded in what is called the current account balance. So also, besides the merchandise, the service balance, trade balance, the international flows of income, we also have the so-called unilateral transfers. So those are payments that governments, private charities, or individuals make in which they send money abroad without receiving any direct good or service. So one example of this is what people send abroad when they work here. So many people who work in America and they have families somewhere else, so they sometimes or regularly send money abroad. So that is also captured in the unilateral transfers. So in many cases, charities, for example, what the Gates Foundation does around the world, providing help for people with diseases, including HIV. So those are private charities that of course, money is flowing. So this money is given away without receiving any direct good or services. So that is the difference between the merchandise and the service. You are getting money in return because you are selling a good or a service. In this case, unilateral transfers are only payments given by either governments private charities and individuals that send money abroad, or vice versa. So in many cases, countries, well, it's not very common that America receives help, but in some cases we do. So, so this help that was offered by the United Nations, they were offering some testing devices. So the government rejected that because the quality was not the one that the country was looking forward to have. But so that probably can be a unilateral transfers. So those are transfers that governments, private individuals, or organizations made abroad. Okay, so this is an example of a current account. So this current account, those are the components of the U.S. current account balance for 2015. This is the first quarter, and the value is in billions of dollars. So we have goods like, for example, refrigerators, cars, let's say computers, anything that is produced in America. So this is the value of exports, and this is the value of imports. At the end, we can see that this is the merchandise. Well, that's the one that is called the merchandise. Well, merchandise. Let's leave it like this. So this is the merchandise account. So so this is the merchandise account. So we have values of goods for 410. We have imports for 595. So we have a negative balance in the goods item. Also, we have services, as I mentioned, financial services, legal services, healthcare. Those things are priced. So we have a value of exports, we have a value of imports. And of course, in many cases, because America is good at producing services, we have a surplus in the service balance. Somebody's asking a question. Okay. So we also have income receipts and payments. So those are payments made by, so this is money received by, so this is the money received on foreign investments. So, so that is what Americans who have businesses abroad, they are receiving from other countries, and they bring that money to America. So this counts as exports. So those are income receipts and payments. And this is the value of payments to foreign investors. So people who have companies in America like Toyota, I don't know, BMW. So all these foreign companies, they have a value of imports. So in this case, I don't know, I think that might be a mistake because it doesn't account for the value. I guess I made a mistake somewhere in here. So I will double check. But so we also have the unilateral transfers. So these unilateral transfers are payments made abroad without receiving any direct good or service. So we also have a negative balance. So I'm gonna double check this one because that doesn't look right. So so we have unilateral transfers. So in this case, we have a negative result. So that means that we are sending money abroad more than what other people send to Americans. For example, this is the probably if I am working, I send money to Mexico. So that counts as an import because I am sending money. And the opposite is when people are sending those resources to America. So we have that unilateral transfers are higher than those that we are receiving. So at the end, if we do the math, so we are going to have a current account that the value of export is 820 and the value of imports is 934. So we have a deficit in this current account. So once again, we have goods and services, we have income payments, so money that we are paying to those who are investing in America and those Americans who are investing abroad. That's what they receive. So unilateral transfer, money that any individual can send to other countries. So at the end, we have a big deficit in trade balance. So if we account for goods and services, we can see that the balance is higher. It's almost like $130 billion. And this is only because of goods and services. And if we include income payments and unilateral transfers, so probably we are going to still in deficit. So we are importing many goods, and that's the reason of the deficit in our account. So and this is interesting. This is just like one shot at what happens. But if we look at this more in depth, let me make this bigger for the time being. So here we have how much the trade balance has been in the past years, well, meaning from the 60s to the 2000s. So we have, for example, in the 60s, we almost are even. Balance has been, the trade has been balanced for the 15, 20 years of our observations. But starting in the 80s, we have current account and merchandise trade balance. So this is one of the main drivers of the trade, trade balance, and the current account balance is going to be the merchandise. So if we can, hold on. So if we look at this, so what is driving this current account deficit is basically the goods or the merchandise balance. So that's what we are looking at here. So we are looking at a case where the current account becomes negative, and basically the merchandise trade balance is the one that is driving those big deficits. So we are importing from soaps, clothes, shoes, almost everything that is produced abroad. So I was, so due to this crisis, I was hearing that, I mean, most of the pharmaceuticals are not produced in America. Many of the goods that are intermediary goods for military, for the production of military equipment are not made in America. So at some point we are buying all these inputs somewhere else, and that's what is driving the trade balance very low. So you might notice that in 2005, we have a big deficit, almost $700 billion. But by 2009, we have almost $400 billion. So the deficit is lower, so from 700 to 400. So that probably is an indication that when recessions are happening, so trade balances tend to improve. So we import less, and there is a reason for that. We are going to talk about this later. When the economy grows, so that's when we import the most. When we have recessions, we reduce the amount of imports. So that probably is not a law, but seems like a pattern. Higher economic growth comes with higher income, and higher income comes with the consumption of more goods and services. Some of these goods and services that we are consuming in addition are going to come from another country. So that's the reason good economic growth implies bigger current account deficits. Recessions are doing the opposite. They are reducing the amount of imports, and in this case, as we can see, the current account balance is being lower. Okay, so graph A shows the current account balance and merchandise trade balance in billions of dollars from 1960 to 2013. So these lines that is above is below zero, as I said before, they represent deficits. So here we can see neither deficit nor surplus, it's almost in balance. So this is the second part. So we are looking at the current account and the merchandise balance as a percentage of GDP. That's different from this, because this is the number, the raw number. This is looking at these values having the GDP as the reference. So if we go back to the same line, so probably this trade balance was not that bad, because in reality, as percentage of the GDP, that allows us to be almost in some good side, so in the positive side. So, so we can see the same trend that by 1970s, so we start incurring in these big deficits. So this is as a percentage of the GDP. So here, for example, in 1990, whatever is the number here represented a 1% of the GDP. Here, the current account balance was almost in balance. So as we move to the right, we can see that the share of both the current account balance and the merchandise trade balance are very big, almost 5-6% of the GDP, which is very, very big. So we are gonna mention some cases a little bit later, okay? So, so this is important. We're having two different shots, one that shows the GDP in real numbers, in billions of dollars, and this is the amount that we are, this is the size of the trade deficit. So this is the percentage, which is always more informative, right? So, and we can see that by 2005, we're in big trouble, because we almost, I mean, this number has been increasing for a long time. But also remember, the 90s and the 2000s are periods of very strong economic growth. So as I said before, it's not a surprise that as the economy grows, we are importing more goods and services, okay? So this is also the level of imbalance of trade. So we have the exports of goods and services. So, and this is the current account balance. So we can see that, so this is export of goods and services, I guess, as a share of the GDP. And this is the current account balance, also, I guess, as a share of the GDP. So that is very important, because it seems that goods and services are very strong. So we are exporting a lot. So we can see that compared to other countries, for instance, Germany has a huge level of trade balance. So this level of trade balance is going to be exports divided by GDP. So if I take the number of exports and I divide it by the size of the GDP, I'm going to have this level of balance, this level of trade. So that tells me that 17% of the economy, almost 18% of the economy, is due to exports. Here in Germany, almost 50% of the economy is represented by exports. So we have this pattern in Sweden, North Korea, South Korea, and is less accentuated in Nigeria, India, Brazil. So we can see that Mexico has a very strong component of exports. And so let me find some of the tables that I was supposed to show you guys. So we have the list of countries by current account. So remember, the current account includes the exports and imports of goods, services, unilateral transfers, and the income receipts and payments. So all these things are captured here. So we can see that, for example, Germany is in a very good territory. For example, Germany followed by Japan, China. So they are huge exporters. They are, well, they basically, their current account is bigger than at least in the positive side. So that means that basically they might be importing more than what they are, sorry, they are exporting more than what they are importing. So we have these billions of dollars. So this is almost 300 billions of dollars. So this is almost $200 billion, and this is $165 billion. So this is the size of the surplus for these economies. So we have some other countries, and what we can also see is that the United States is the largest importer. So the US carries the largest deficit of any country in the world. So I think it's fair to look at this as a, well, probably not as a weakness, but I guess that number is way too big. So almost $500 billion in deficit in current account payments is very big. Because remember, this number has been kind of like lowered. So the goods and merchandise should be very high. The deficit in these goods in the merchandise trade balance, it should be very high compared to services and other payments. So that is a big number. So remember, this is the current account, and the current account is in deficit. Huge numbers that we can see. So if we look at what the US, the deficit of the US probably is the surplus of these three countries. And that's a lot of money. So, and I do believe that trade is very important. However, there should be like a more not more balanced, but more reciprocal. So we know that these countries have very high levels of taxes for American goods. So it's unfair because Americans, there are less restriction in trade. But anyways, that's the number. Those are the numbers. So we can see that the largest countries with deficit in current account balance are the US, the UK, India. So in some cases, these negative numbers, as per the case of the United States, is not that bad. Because in some cases, that represents some intermediate goods that we use in America to produce more goods, or some goods that can be produced abroad for a very cheap price. Like, for example, producing shoes in America is very expensive, but if you buy them from Brazil, so those are not expensive. So that makes sense to do this according to the so-called comparative advantage. So, so we have that, and that's very important. So once again, largest deficits, largest surplus in the current account balances. So also we have, well, this is a picture of the current account balance from Fred. We know that Fred is the Federal Reserve Bank of St. Louis. So we have a very interesting chart. So we can see from the past 10 years of the maximum. Is that the maximum? This is 10 years. Yeah. So we have how trade balances have been increasing throughout the 200s, decrease in 2008, 2009, and then it's kind of flattering in the whole time. So in the past years tends to widen again. So, and that is, those are the numbers. So this is very informative because we have almost information for 20 years. So, so we have information for 20 years. And we can see how the trade balance has been moving. Well, not the trade balance, the current account. So probably if we look at more disaggregated data, we can see the different items of these transactions, okay? So I guess here we have also some information, the Bureau of Economic Analysis. They also provide very good information in terms of international transactions. And this is very nice because we can see the trend. This is the current account. We can see goods and services and some other things. That's a very interesting table. So so basically we have this table, very interesting. We have this table, this graph that shows us how trade balance have been happening in the past 40, 50 years. So, and this is also important because we can see the share of exports as GDP, as part of the GDP. And we can see that the US relies a lot on exports, but not as much as Germany or Canada. So remember, Canada, at least something that I know, is a country that has lots of oil. So most of the production of the Canadians is petroleum. So this petroleum basically includes a big chunk of their gross domestic product. Sweden also, I guess, part of the exports are also oil. So these Nordic countries are relied in the production of oil. So, so South Korea is another example. Probably we will mention it later because that is a very good example of economic growth. So, so this measure of an economy's globalization. So we have the export of goods and services as the percentage of the GDP. So that indicator is called the degree of openness. So the degree of openness is the dollar value of exports by the dollar value of the country's GDP. Well, basically, that is more the level of trade. It's called level of trade. But the level of trade, as I said before, is going to be equal to the exports divided by the GDP. But also we have what is called the degree of openness. The degree of openness is an indicator of globalization. For example, besides the level of trade, we have the degree of openness, which is exports plus imports as a share of the GDP. So this degree of openness describes how much the domestic economy is linked to the international economy. So the more open the economy, the more vulnerable to shocks in international prices of goods and services. Just imagine Venezuela. When the price of oil is very high, they are happy because that represents revenues. But when the cost of oil is very low, so they are not very happy because they are losing revenues. So so that's the thing. Let me see if I can open this link. I think I can. So those are some of the rankings. So we have the degree of openness. So as you can see, countries like Luxembourg, just imagine again our equation, exports, openness is equal to exports plus imports divided by GDP. So what we are going to do is we are going to take this segment, we're going to add it, and then divide it by the size of this. So in this case, what we can see is that Luxembourg has a 400% degree of openness. So that means a lot. So probably they don't produce anything here. Everything that is consumed in the country is bought from other places. Like for example, I don't know what they produce, but whatever they produce, they export it, they get the money, and they buy everything else from other countries. So that probably makes more sense for Hong Kong. Hong Kong is a very small place and it's very populated. So can you imagine building agricultural goods or some other things? So there is no space, but they produce a lot of financial services. They produce a lot of some manufacturers. So they are able to sell those goods and then buy almost everything else. So most of the things that are consumed in Hong Kong, they are not produced in Hong Kong. So we have some other cases, and you might expect to see the United States in a place that is among the first, but that is the opposite. So the degree of openness in America is one of the lowest, which might be not bad because some of these shocks in other countries, of course, they affect the US. But just imagine relying on oil, on some other goods. So of course, they are going to be highly affected. So we can see among these countries, some European countries, and many of these countries are producing a single commodity, like the United Arab Emirates. So they just produce oil. So they produce oil, they sell it, and then buy anything else. So that's what the degree of openness is telling me. So so this is how attached the domestic economy is to the international economy. But also we have this level of trade that is recorded as exports as a share of the GDP. So basically this is what is telling me how strong internal production that goes abroad is. So what is the share of the domestic production that is sold abroad? So and also we have a picture of the current account balance. As we can see, countries, well, it's hard to generalize, but the current account balance can be different from these values, or they might not be a straight relationship. So we cannot say that those with highest level of trade are better than, they have better current account balances. We have the case of Canada, where they have a large share of export as part of the GDP, but they still have a current account balance that is in deficit. This is also the case of Mexico, and even though this country, the US, has a smaller level of trade, still they have a current account deficit. So is there any questions so far? Is there any questions so far? So let me see. Okay. So okay. So we also have this nice sorry, I'm kind of lost right now. Okay. So this is a measure of economy's globalization, either the level of trade. So let me put this very clear. So this is the level of trade, or the degree of openness. So this degree of openness is here. So they are not the same, but they have the idea of expressing how much domestic economies are depending on the international economy. So is that better that we have a lower or a higher? Well, it depends very much on the country. So we also have this concept, financial capital. So basically that is going to be the key, whether or not these current account balances and these surpluses can be helpful in the economy. So financial capital is the international flow of money that facilitates trade and investments. Just imagine that you have a current account balance. So you have all your consumption, investment, government spending, and your foreign sector. How are you going to pay for these current account balances? Well, this is part of the answer. So, and the key relies on the concept of financial capital. So those are international flows of money, either inflows or outflows, that facilitate trade and investment. So the connection between trade balances and international flow of financial capital is very close. So it's very hard sometimes to describe both separately. And in many cases, for many people, the balance of trade is very close, is a good approximation for the balance of payments. So we are going to define more in depth the second one. So, so each category of the current account involves a corresponding flow of payments between a given country and the rest of the world. So, looking at my notes. So, so this is very important because, for example, we are going to build the links between the financial capital and the balance of trade. And for example, when we have a trade deficit, so that means that we are borrowing money from other countries. So when we have a trade deficit, so we have to find the money from somewhere, either domestic savings or foreign savings, right? So if we have a trade deficit, very likely we are going to be borrowing money from other countries. So this international borrowing is going to be as an inflow of capital from other countries. The opposite is when we have a trade surplus. So because we have a trade surplus, so we are able to lend money to other people. So this trade surplus is going to create an outflow of international capital. So Americans, they are going to have this trade surplus. They are going to become lenders, and they are going to be lending money to other countries. Unfortunately, for the American economy in the 60s, the 70s, a little part of the 80s, most of the times, America was an international lender. But after the 80s, the US has been carrying these big trade balances, these big trade deficits, and became an international borrower. So the position changed. So that is something that I have to mention. Okay. So so this is also something very nice. We have it's kind of an explanation of how the flow of investments of goods and capital, because remember, it's not only goods and services, but also capital. So we are thinking that, for example, Americans are investing somewhere and foreigners are investing in America. So at some point, this is a flow of money that comes in and out. So just imagine that this is the home country, this is the United States, and any other country is going to be called the rest of the world. So that is a very common nomenclature that is used in this context. So we are the home country, and everybody else represents the rest of the world. So also I have to say that in your slides, this graph is incorrect. So I will be sending this again after the class. So here what we have is that, for example, the home country, they produce goods and services that are exported to the rest of the world. In return, the rest of the world make payments for those exports. So the rest of the world sends imports to America, to the home country. So the home country sends payments for imports. So at the same time, so this is the goods section, the section for goods and services. This is the section for capital. So at some point, these goods are coming in and out of the country, and they have payments here and there. But also at the same time, Americans are investing in the rest of the world. And then the rest of the world make payments to investors. So investors earn their income in those countries, and they bring the money back to the United States. But also some foreign companies are investing in America, and at some point they are expecting that those investments to pay their dividends. So the money is going back to the rest of the world. So that's how goods and services as well as capital flows are happening between the home country and the rest of the world. So that happens so many times throughout the year, throughout the decades, that becomes a flow that needs to be understood. So each element of the current account balance involves a flow of financial payments between countries. So we have exports, imports, we have foreign investors and domestic investors in other countries. So so that's important to know. This is like the well, this is a very nice explanation on how these transactions are happening. So so anyways, we have also, so let me see if I make, so I mentioned that this the picture in the slides is incorrect, so you have to be careful with that. So the balance of trade as the balance of payments. So the current account deficit means that we are a net borrower from abroad. So just imagine that we have to pay for imports and exports. We have to create the money. So in many cases, we are borrowing that money from abroad. Conversely, a positive current account balance, so that means that we are in surplus. So the country is a net lender to the rest of the world. So an inflow and an outflow of foreign capital does not necessarily refer to the debt of the government or what the government owes to other governments. So that's different. So those are transactions that are happening as merchandises are crossing the borders. So these international flows of financial capital refer to all of the ways in which private investors in one country might invest in another country. And there are many ways how investors invest in other countries. In many cases, they can buy real estate, they can buy companies, or they can buy stock in the financial markets. So, so in many cases, buying companies becomes very popular nowadays. So, especially with the advances of technology. So, and this is, so this is one of the advantages of these international flows of capital. For example, this is, so I have heard these comments very often. In the past, well, there were some issues with China because they were, well, some experts say that they were stealing intellectual property. But because now, well, these international flows of capitals are very easy to do, so they don't have to buy the technology, they just buy the company and they acquire the company, the technology that comes with this purchase. So that's very good for countries when they have the capital to do that. So they are lowering the learning curve for technology. But basically these international flows of capital are happening in the case of real estate, to buy companies, physical assets in the production sector, or intangible assets in the financial sector, like stocks and bonds. So so then that goes to the next step. So we are going to look at the relationship between trade balances, flow of capital, and how savings and financial investments happen in the world. So something that we need to know is, like, for example, in a closed economy, so in a closed economy, the identity between S equal to I. So like in most of the cases, investments are going to be equal to domestic savings, which is something that we are expecting. For example, you want to produce you want to open a company and you have the idea, you need the capital. So you are going to invest and you are going to borrow money from the domestic market. You go to the bank in around your corner, knock on the door and say, I need a loan. So this is a very important identity, that most of the investment or investments are funded by domestic savings. but this is in a closed economy. Remember, we are dealing here with a closed economy. But here we have an open economy. We have an economy that includes imports and exports. So we have to redo this identity. So these are national savings and investment identity. So it's the total of private savings and public savings. Well, in this case, the public savings is when the government has a surplus. So we are assuming here that we have a market for financial capitals where the suppliers are the savings, those who are saving in the economy. And remember, having a trade deficit implies inflows of capital. So we are going to be able to deal with the issue of investments because we have besides the domestic savings, we are going to have savings from the rest of the world. So, and in this case, investments are also attached to public savings. So in this case, we are assuming that at some point, or at this particular case, the government is having a surplus. Okay, so savings. Well, the S is savings by individual firms. M minus X is exports minus imports. Imports minus exports. This is the trade deficit. So we have the private sector investment, government spending, and the taxes that are collected. So remember, well, this is the government, not the government surplus, but the government deficit. So in this case, G, which is the spending, exceeds taxes. So, so we have this identity that is very important. So the supply of financial capitals should be equal to the demand for financial capitals. So taking a look at these cases, for example, if we have a budget deficit, so then the government would be the demander of financial capital. So if the government has a budget deficit, so they can borrow money either from domestic savers or from the rest of the world. So also the level of investments depend on the amount of savings in the domestic economy as well as the level of savings in the foreign sector. So in this case, a budget deficit, so then the government would be a demander of financial capital. If the opposite happens, we have a surplus, then the government would contribute as supplier of financial capitals. So that probably benefit investments and probably would finance some of these budget trade deficits. So those are very important identities. Let me see what else I have here. So domestic savings, households, yeah, okay. So so that's basically the idea. So we have this identity, once again, the closed economy, savings equals investments. Now we have an open economy where we allowed for exports and imports and the role of governments. So so the connection of domestic savings and investments to trade balance explains why economists' views of the balanced trade, or they view the balanced trade as a fundamentally macroeconomic phenomenon. For example, in this case, we are modifying the original equation. So we are basically solving for trade balance, and now the trade balance are going to be part of these investments. So the amount of budget, the amount of deficit or surplus in trade is going to depend on investments, the size of the budget deficit, and the domestic say those who are saving in the domestic economy. So in the case of a trade deficit, the national savings and investment identity can be written as follows. So we have the trade deficit where imports are higher than exports. So these domestic private investments are going to be financed with these inflows of capital. Remember, every time we have a deficit, so capitals have to be borrowed from another place. So that can be good for investors. So assuming that this identity is zero, any excess in the investments besides so let's say that investors have already exhausted any of the resources from domestic savings and the public savings. So now any excess in these investments are going to be explained by the size of the trade deficit. So, so remember, trade deficits represents inflows of financial capitals. So the only way that a domestic investment can exceed domestic saving is if capital is flowing into a country from abroad. So any excess of investments besides the savings are going to be financed by the inflow of capital from other countries. So if we look at the same equation, but from the point of view of a trade surplus, so in the case of a trade surplus, the national savings and investment identity can be written as follows. So in this case, trade surplus, so depends on the private domestic savings and the public savings. So domestic saving, both public and private, is higher than the domestic investments. So the extra financial capital has to be invested abroad. So just imagine that domestic investors the level of investment is very high. So let's say that we need $100 for investments, and we have, let's do the following. So let's say that we have $50 in savings and $50 in public savings. So let's assume that we have only, so taxation is bigger than government spending. So, and we need only $90 for investments. So that basically means that we are going to have a $10 sorry, $10. So we are going to be lending to the rest of the world $10. So because the excess of savings and public savings, private and public savings, are exceeding the level of domestic investments. So investors decide only to invest 90, but we have $100 in savings. So those savings are going to be well used in other countries. Okay, so that's the idea of these two equations. When we have a trade deficit, so we can invest higher than our domestic capabilities, because this trade deficit is causing an inflow of money. So conversely, in this case, when the domestic savings, both public and private, exceed the demands for investment for domestic investors, so the rest of the money is going to be invested in other countries. Okay, so that's basically what this idea is telling me, and that is the key issue. So having a trade deficit or having a trade surplus is good or bad, or is better to have a trade balance? Well, that is a very big question that we need to answer at some point. So, so in this case, as I mentioned before, so the excess of public and private savings are helping the rest of the world to produce more investments. So we have this very nice table, which I really like a lot. So that explains a lot what happens. So what is the link between domestic factors like investment, savings, private and public savings? So and what is the links with the trade balance? So in this case, so just imagine that this is the same equation that we are seeing here or here. So this is a modification. So investments minus private savings and public savings are going to be equal to the size of the trade deficit, right? So so in this equation, what happens if the domestic investments are increasing? So let's say that there is a demand for more investments in the domestic economy, assuming that this is fixed and this is also fixed. So we need more than the equilibrium. So what happens is that the trade balance must increase. So when the trade balance increases, we have an inflow of capitals because we need the money for those to finance this trade balance. So that might be a source for investments in the domestic economy. So in the second case, we are assuming that the domestic investment is the same. But for some reasons, investors are investing more in the country. For example, people believe that or there is a good interest rate that is higher than any other investment. So people, rather than investing in the market, they invest in the banking system. So more money is going to be available for lending. So investments are the same. The budget deficit or surplus is the same. The only thing that is happening is that this amount of savings are increasing. Well, when there is no change in domestic investments, but private domestic savings are higher with no change in public savings. So that means that this trade balance is gonna decline. Well, because we don't need that money. We don't need to borrow money. Remember, trade deficits are inflows of capital. Now these domestic savings are allowing me to pay for any desire for investments. So in this case, when the level of savings, domestic savings are increasing, keeping the other two fixed. So in order to keep the balance, the trade deficit has to decrease, okay? So the third case is when we have a public savings, when the public savings is decreasing, is going down, with domestic investments and private domestic savings are the same. So in that case, so this surplus is becoming lower and lower. So then the trade balance must increase. So so this surplus, these savings are being depleted, and at some point it can be negative. So that's a good point for the trade balance to rise. So not for the trade balance, for the deficit to increase. So this is a very nice relationship that shows how the foreign sector is depending or is related to the domestic components of the economy. So so that is very interesting. So so this is exploring trade balance one factor at a time. So we have three different factors, and the reference is the trade deficit. When the domestic investments are increasing, of course, we are expecting the trade deficit to increase because we are expecting those inflows of money. When the private savings are increasing, that means we don't need money from abroad. So that has to come down. And in the case of public savings, so this is the size of the government budget. In this case, is the size of the surplus. So the lower the surplus, the more the need to finance those shortcomings. So we are expecting the trade balance to be more negative, okay? So in short, whether an economy is in recession or is on the upswing can affect trade imbalance. And that's something that we basically, well, we made a brief comment at the beginning. And what I say is that when the recession takes place, so trade deficits are smaller. Why? Because when we have trade deficits, when we have a recession, so we have less income. Basically, that less income means that we are buying less goods from everybody, including people from foreign citizens. So recessions tends to make the trade deficit smaller, or if we have a surplus, that surplus is going to be higher. So remember, what happens here, is that the recession basically decreases the size of imports. So if we have export minus imports, so, and this is a deficit, though the deficit is going to be smaller. But if we have a surplus, because we are keeping those imports at a lower rate, so we either can have a smaller deficit or a larger surplus. So in the second case, when the economy is booming, we have a very big economy. Remember, a big economy increases the income, and that income leads to people to buy more. So they increase their consumption and increase their investments. So just imagine that this is an I. So that means that because we are increasing consumption and investment, some of these are going to be domestic, but also some of these goods are going to be foreign goods. So every time the economy does well, so we buy more in consumption and investment. Some of these goods have to be from other countries. For example, when Americans are doing fine, they buy more cars, they buy more computers. But among those cars, let's say cars, so consumers are buying more, I don't know, BMWs, Mercedes. So that means that those are goods that are produced abroad. So, so that is very interesting because at some point, some of the decisions that happen in the domestic economy, not decisions, but events like recessions or economic growth are always attached to the level of imports and has a big impact on trade balances, okay? So, so also, so is that always, I mean, is these relationships always good? So having a trade deficit is better than having a trade surplus? So, or having well, that's the question we have been asking from the very beginning. So for countries, there is no economic merit in policies of abstaining from participating in financial markets. Just remember when we have this, so this one, the surplus or the deficit, so either we were borrowing money from abroad or we were providing funds for the rest of the world. So that is an advantageous position. So either having a trade deficit or having a trade surplus is not bad by itself. So we cannot say that in either of these positions is bad.
Every time you look at the class, you click no ya budu.
Hello?
Yes.
Okay, I'm gonna, is that a question? Okay, so so we have cases with deficits and surpluses that have been good or bad. So it can make economic sense for a nation economy to borrow from abroad as long as it's wisely invested in things that are helping economic growth. For example, if you read the chapter, there is a segment when the author describes what happens with this particular case. and he describes the case of Friday and Robinson Crusoe. So they are kind of engaged in economic activity, and one wants to produce something, but he needs time, so he asks Friday to produce goods, so he's going to be borrowing those goods. So in the future, what he's building is going to be beneficial, so he's going to be able to pay that money back to Friday. So in this case, that makes sense. You are borrowing money, you are building and rebuilding your infrastructure, you are buying capital goods. So that is a very good way to, so that might be a very good reason for carrying a trade deficit. So you are using the money that is coming into your country to produce goods and services. So that is the case of the United States in the mid 1800s. Remember, this is the time where industrialization happened in the United States. So the big railroads and the big steel companies are being built in the mid 1800s. And that was basically because the country was borrowing money from abroad. The same experience happened with South Korea. So South Korea, as far as I know, they had big trade deficits, and those big trade deficits were very good because they were able to produce and then become exporters of goods and services. So that is a very good way to use these inflows of capital and keep these trade balances in deficit. However, when you borrow the money but don't invest the money properly, that leads to a bad outcome, which is the loss of productivity. We have very bad cases. I was in Mexico in the 70s and in the 80s. But by the way, when I was there in the 70s, I was very young. So, so Mexico, Brazil, and some other countries, they just wasted the money. They borrowed the money, they didn't build the infrastructure, and the consequences were really bad. 70s and 80s, these countries have major financial crisis because they kept their current account in extremely high levels. So they borrow money from other countries, and they basically didn't invest the money in a proper way. So that is a bad experience for trade deficits. So is any question over there? My computer keeps disconnecting. Okay. So so for those who are having this problem, if your computer is disconnecting, I'm recording this so you will be able to hear it later. So the difference between the level of trade and the trade balance. So I was mentioning that this level of trade is basically, so this level of trade, we define this as exports divided by the economy. So, so that is separate from the trade balance. Remember, the trade balance basically is export minus imports. So those are two different things. So the trade balance tells me how much in excess imports are from exports. So we mentioned that in the case of the United States, almost $500 billion in deficit. So that means we are buying more from abroad than what we are selling to other countries. And this is different because I want to account for how much exports account for as a share of the GDP. So we have two different issues. These ones are measured as part of the GDP. So, and there are three factors. Well, first of all, let me tell you the following. Just imagine that we have two different countries. Country A, we have a GDP that is equal to 1,000. So we have exports equals to 50, and we have imports equal to 60, right? So we have this. Also, we have country B. Let me put B here. So we have country B. So country B GDP is equal to $100. We have exports that are equal to 50, and imports that are equal to 60, right? So that can happen. That can happen. Remember, for our account, so that can happen. Even though 50 and 60 are greater than 100, remember that when we are accounting for the GDP, this is one minus the other. So that the output of this is going to be only minus 10, okay? So that is the case. For example, what is here the level of income? The level of trade. So in this case, the level of trade is going to be 50 divided by 1,000, right? So in terms, we have a 5% level of trade, right? So that means that the size of exports only represent a 5% of my my GDP, right? So that is not that bad. But also, if I want to do the trade balance, so I'm going to do the following. I'm going to say exports minus imports. So that means I have a minus 10, right? So my point is the following. So we are going to be looking at two different things. So one is the level of trade, that is 5% of my economy, might not be bad. So trade balance is going to be minus 10. So if I do the same for the second country, the level of trade is going to be equal to 50. So they have the same level of exports, but they have a different GDP. So in this case, that's going to represent 50%, right? And in this case, the trade balance is going to be also a deficit because we have 50 minus 60. So that is going to be equal to minus 10, right? So in this case, that's what this part is trying to tell me. So we have two different things. One is the country's level of trade, and the other one is the trade balance. So either one is good, the other is not good. Hold on, I think I missed one of the tables. Oh, that was the degree of openness, and that will already solve. Okay. Oh, but we will come back to this. So that's not the one. Okay. So those are the issues that we are dealing with. So on one side, we have the level of trade, and then we have the trade balance. So in some cases, we might have, like this case, that the level of trade is not that much, but still we have a trade balance, a deficit in trade balance. So, and as we can see, the difference in trade balance is not different from one country to another. What is different is the level of trade. In this case, $50 in exports represents only a 5% of the GDP, but here, $50 in exports represents almost 50% of the economy. So we have cases like this. I think I was mentioning some of these countries with a very big component of exports and imports. So, so we mentioned that before. So there are three factors that influence the level of trade. So one is the size of the economy. As we can see here, so the size of the economy is telling me how strong the level of trade is defining my trade relationships with other countries. So in this case, the size of the American, well, the size of the A economy tends to be very high compared to B. So that means that B might be more vulnerable to fluctuation in prices, international prices. Also, this relationship can also be determined by geographic location. For example, let's say, and the book says that. So just imagine Norway. Norway, so the level of trade is very high. They still have some trade deficit, or they might have a trade surplus. But the fact that they are part of or very close to the European Union, they can make so many transactions with so many countries. So that is advantageous for them compared to the United States. So the US only has 2 different countries that can trade, do trade with Canada and Mexico. So in between those countries or beyond these countries, there is almost sea, like water. So so that means that this level of trade and these trade balances might be also influenced by the geographical location. And in some cases, it has to do with the history of trade. So, so the size of the economy here in the United States, or in this case, country A, is too big. They probably are able to meet their needs by producing domestically what they need. So some of this excess is going to be exported, some is going to be imported, but the size is not that big. So in this case, some countries that traditionally have been countries that are engaged in trade with other countries, like Sweden, so that means that this history of trade can also play a big role in the level of trade. So exports from Sweden to other countries might be very high because the proximity of other countries. So, so do you think that the following countries have a low or high level of trade? Well, very likely Sweden, because of these 3 categories, might have a very high level of trade. It's a very small economy compared to other countries. Its geographical location is, well, it's in the middle, it's very close to all European countries, and the history of trade is very important. So very likely, and we almost say that before, the US might not be or might have a very low level of trade. And probably Japan might have the same thing. So Japan is an island, and they have the Chinese, they have the South Korean, and I don't know if they are good neighbors, but it seems that they are not. So very likely the level of trade might be lower compared to other countries. So final thoughts about trade balances. Trade deficits can be good or bad, as well as surpluses. And even the zero trade balance it depends on what you do with the money that flows between countries. It's not only the trade balance, the buying goods from abroad and selling goods to other countries, and the consequences of the inflows and outflows of capital or financial capital is what people and nations do with the money. So here the fundamental question is not whether a nation's economy is borrowing or lending at all. I think they benefit from that. So you take advantage of your economy. So remember, this idea is based on the concept of the comparative advantage. So when you specialize in something, you do your best, and then you are able to increase your production in the good that you do the best, and then you allow the other country to produce what they are good at, and then you trade. So in this trade, you are basically using these inflows and outflows of money. You can borrow money, you can lend money depending on your trade balance. But so the rule says either position can be good as long as the resources are well used. So if those resources are used to promote growth, very likely either of these positions is going to be good for your domestic economy. So I guess that's it for today. So this is a very important topic. I guess so many of the things that we have been hearing for some times, or at least I am interested in, like for example, the fact that we have a very big trade balance, trade deficit, also the fact that, for example, this is happening in the assumption that you are borrowing money or money is flowing in, no, in this case, so money is flowing in because you have a trade deficit, but you are assuming that the government is carrying a surplus, which is not true. So in many cases, we have huge trade deficits with huge, gigantic government deficits. So the size of the borrowing money from other countries is even bigger because we need money not only for domestic investments, but also we need money to finance government's activities. So that places so many questions, and I guess this this idea is very helpful, and I hope you see that in this chapter. So is there any question? Is there anything that you want to say regarding the chapter? Yes, no, maybe? So is there any other question regarding the class? So we already covered that issue. I'm gonna review the dates. I am going to, I'm gonna send an email, and I said that those who are missing some work, you might be able to do it, but once again, you're gonna be penalized because it's not fair for students who are doing the homework on time. So please, if you have questions, let us know. We also mentioned that we are open for Zoom office hours. So whenever is needed, please let us know, and we are gonna do our best to accommodate our case.
I have a question.
Yes, please.
Will you give additional opportunities for extra credit?
That might be a good point. Yes, I think I'm going to consider that. There are a couple of things that you can do. Probably, yeah, I mean, I have some things that, yeah, I'm going to think about it. Basically, probably watching some documentaries or some things that are available online. So if you are able to watch it and then write a short report, I will give you some extra credit, of course. Okay?
Professor,
Yes.
so for the people that did submit their reflection paper on time and they will redo it, will they still get points taken off?
Say that again. You submitted on time and?
Submitted on time and I'm gonna redo it because I wanted to get a better grade. Will we still get points taken off?
Well, I mean, if you, for example, you did the assignment and you got 1 point, 2 points off, that's not a big issue because you can compensate those points with an extra assignment, right? So if you got more than 2 points, of course, you are welcome to resubmit. That might be good. Just if you are, whoever is submitting the work again, please make sure that you make a big note in the first line of your work. So I know that this is a person who is submitting 2 works, okay? Otherwise, I don't have a crystal ball. So if I see your paper, I am assuming that this is only 1 paper. You have to be very clear and tell me that you are redoing the work, okay?
Okay, do we resubmit it on Blackboard or through our, or we email it to you?
In the second Dropbox, let me see, Blackboard. So in the second Dropbox, Dios mío. In the second Dropbox, if you go to the class, you go to module 2, So you have here a reflection paper, right? So here you send your 2 documents. One document, you have the 2 reflection papers. You cannot do separately. You have to do 1 single paper You put the first assignment in the front, the second assignment below, and make a note, say, I am resubmitting my first paper, and I will take a look at that, okay?
Thank you.
Sure, but you have to do it you cannot resubmit it in module 1, you have to do it in module 2, and you have to tell me that you are doing a review of the paper, okay?
Got it.
Okie dokie. Any other question? Joshua?
Yeah, I just got a quick question.
Sure.
In the future, will there be any extra credit assignments to maybe regain those lost points?
Yeah, no, I was mentioning, I think Ebony asked whether there's going to be a chance for extra points, and I said yes. I know a couple of documentaries that might be interesting, important, so I will give you some. I mean, I'll let people know, and whoever does it in the time I'm gonna give only 1 week, so I'm gonna make the announcement. You have 1 week to turn your paper in or whatever is due, and then that's gonna be the extra credit. Yes, but I'm gonna make an announcement probably after we come back from spring break.
Okay, thank you. Yeah.
Sure. Any other question? No? Okay, I'm going to stop the